On September 15th, 2008, the world changed. Not slowly, not gradually, overnight. The fourth largest investment bank in American history, a 158-year-old institution that had survived the Civil War, 2 World Wars, and the Great Depression, filed for bankruptcy before the markets even opened. $639 billion in assets. Gone. It was the largest corporate bankruptcy in the history of the United States, and it triggered a global financial collapse that wiped out more than $10 trillion in household wealth, destroyed millions of jobs, and sent shockwaves through every economy on the planet. At the center of it all was one man, Richard S. Fuld Jr., known on Wall Street as the Gorilla, the most feared CEO in banking. This is the story of Dick Fuld and the fall of Lehman Brothers. To understand what happened to Lehman Brothers, you have to understand Dick Fuld. Because Lehman Brothers and Dick Fuld were, by the end, the same thing. Inseparable. And that was the problem. Richard Fuld was born in 1946 in New York City. He attended the University of Colorado and joined Lehman Brothers as a commercial paper trader in 1969. He was not charming. He was not polished. He was aggressive, blunt, and relentless in a way that made even hardened Wall Street veterans uncomfortable. He earned the nickname the Gorilla, not as an insult, but as a tribute, a description of how he operated in the trading pit. He was physical, intimidating. A man who leaned across tables and got in people's faces and made them feel the full weight of his disapproval when they fell short. He rose through Lehman's ranks during some of the firm's most turbulent years. He was there when Lehman was sold to American Express in 1984. He was there when American Express spun it off as an independent company again in 1994. And in 1994, when Lehman went public again after a near-death experience, Fuld became its CEO. He would remain CEO for the next 14 years. For almost a decade and a half, Dick Fuld was Lehman Brothers. Under his leadership, Lehman grew from a mid-tier firm into a genuine Wall Street powerhouse. The stock price rose dramatically. Revenues soared. Fuld was celebrated as a genius. He was named one of the best CEOs in America by multiple publications. By 2007, Lehman reported record earnings of more than $4 billion. But beneath the record profits, something dangerous was being built. The engine of Lehman's growth in the 2000s was real estate. Specifically, the American housing market, which, in the years between 2003 and 2007, seemed like it could only go in one direction. Lehman became one of the most aggressive buyers of mortgage-backed securities on Wall Street. They were securitizing mortgages, bundling home loans into packages and selling them to investors at a furious pace. They acquired multiple mortgage lenders outright, giving them even greater exposure to the housing market. But here is the critical detail that would eventually destroy them. When Lehman securitized mortgage packages for sale, they kept the riskiest portions, the worst loans. The subprime mortgages issued to borrowers with low incomes and poor credit. While other banks were offloading their risk, Lehman was accumulating it. By 2007, Lehman's leverage ratio, the ratio of borrowed money to actual equity, had climbed to 31-to-1. That means for every single dollar of Lehman's own money, they had borrowed $31 to make their bets. At that leverage level, a decline in asset values of just 3 to 4% would wipe out the firm's entire equity. Everything. The whole company. And in 2007, the American housing market began to crack. Fuld had been warned. His own risk managers had raised alarms about the firm's mortgage exposure. The CFO, Aaron Callan, later said publicly that the firm's leadership had a culture that discouraged disagreement. Like Kozlowski at Tyco and Corzine at MF Global, Fuld had built a culture where nobody told the boss what he didn't want to hear and what Fuld believed. What he refused to stop believing, even as the evidence mounted, was that this was a temporary dip, that the housing market would recover, that Lehman would be vindicated. He was wrong. In March 2010, a court-appointed bankruptcy examiner named Anton Valukas released a 200-page report on the Lehman collapse. It was one of the most detailed forensic analyses of a corporate failure ever produced. And buried within its 2,200 pages was a revelation that shocked the financial world. Lehman Brothers had been using an accounting maneuver they called Repo 105. Here is what Repo 105 was. A repo, short for repurchase agreement, is a standard Wall Street instrument. A firm sells assets to another party and agrees to buy them back shortly afterward at a slightly higher price. It is essentially a short-term loan, with the assets as collateral. Repo 105 was a specific version that Lehman used in a very particular way. And the Valukas report concluded it was used to deceive investors and regulators about the true state of Lehman's finances. Here is how it worked. In the days leading up to the end of each financial quarter, when Lehman had to publish its balance sheet for investors, the firm would temporarily move tens of billions of dollars of assets off its books using Repo 105 transactions. They would sell assets to a counterparty, take in cash, use that cash to pay down liabilities, and then, critically, wait until after the quarter ended before buying those assets back. The result was that Lehman's quarterly balance sheet showed a much cleaner, much less leveraged firm than actually existed. The mountain of risky mortgage assets was temporarily hidden. The debt looked lower than it was. The firm appeared healthier than it was. At the peak of this practice in 2008, Lehman was using Repo 105 to move up to $50 billion off its books at the end of each quarter. $50 billion. Temporarily disappeared so that the numbers looked acceptable. The Valukas report concluded that there was no legitimate business purpose for Repo 105 other than balance sheet manipulation. It concluded that Fuld and other senior executives either knew about the practice or were reckless in not knowing. Fuld later claimed he had no knowledge of Repo 105. Few people believed him. In June 2008, Lehman reported a $2.8 billion loss for the second quarter, its first quarterly loss since going public. It was a staggering number. The stock had already lost 73% of its value in the first half of the year. Clients were pulling money. Credit agencies were downgrading the firm. Fuld was desperately trying to find a buyer. He held talks with the Korea Development Bank. Nothing came of it. He held talks with Bank of America. Bank of America chose to acquire Merrill Lynch instead. He held talks with Barclays. Those talks collapsed at the last minute because U.S. regulators declined to guarantee Lehman's trading liabilities, a guarantee that British regulators required before allowing the deal to proceed. And through all of this, through the talks that failed and the clients that fled and the stock that collapsed, Fuld kept telling the public that Lehman was fundamentally sound. He sent internal memos that were almost defiant in their optimism. He publicly attacked short sellers who were betting against the stock. He called the situation a crisis of confidence, not a crisis of solvency. Treasury Secretary Hank Paulson had told Fuld privately that there would be no government bailout. Lehman was on its own. On the weekend of September 13th and 14th, 2008, the most senior officials from the Treasury Department, the Federal Reserve, and the SEC gathered at the New York Fed in a last-ditch effort to find a buyer for Lehman. There wasn't one. No deal materialized. No white knight arrived. On Monday morning, September 15th, 2008, Lehman Brothers filed for bankruptcy. The markets opened, and the world watched in disbelief as the fourth largest investment bank in American history ceased to exist. The Dow Jones Industrial Average fell 504 points that day. Money market funds that held Lehman commercial paper broke the buck. Their value fell below $1 per share for the first time since 1994, triggering a panic that froze the global credit markets. Banks stopped lending to each other. The financial system, which depends on trust and credit the way a body depends on blood and oxygen, went into shock. Within 6 months, global equity markets had lost more than 50% of their value. In October 2008, Fuld appeared before the House Committee on Oversight and Government Reform. Congressman Henry Waxman of California looked at him across the hearing table and asked a question that became one of the most memorable moments of the entire financial crisis.
Your company is now bankrupt, Waxman said. Our economy is in crisis, but you get to keep $480 million. I have a very basic question for you. Is this fair?
Fuld pushed back on the number. He said he had actually taken approximately $300 million in pay and bonuses over his final 8 years at Lehman. He said he believed at all times that the decisions he made were in the best interest of the firm.
$300 million for presiding over the largest corporate bankruptcy in American history. Was anyone held criminally accountable? No. The Department of Justice investigated. The SEC investigated. Despite the Valukas report's findings about Repo 105, no criminal charges were ever filed against Dick Fuld or any other Lehman executive. The SEC ultimately declined to bring enforcement action. In 2016, Fuld settled a civil suit and paid no penalty. In 2021, the SEC closed its investigation into the Repo 105 accounting without charges. The man walked away. The human cost of the Lehman collapse is almost impossible to fully measure. The 2008 financial crisis that Lehman's failure accelerated wiped out trillions of dollars in American household wealth. Retirement accounts that had taken lifetimes to build were cut in half. People who had done everything right, worked hard, saved, invested, saw their futures evaporate. Unemployment in the United States peaked at 10% in October 2009. Millions of Americans lost their jobs. Millions more lost their homes in the foreclosure crisis that followed. The effects were felt in every country on earth. And Dick Fuld? He has largely stayed out of the public eye. He has maintained, in the few interviews he has given, that Lehman was killed by a crisis of confidence and government inaction. Not by his decisions. He has never expressed the kind of remorse that the scale of the damage might seem to demand. In 2009, a man walked up to him in the gym of his building and punched him in the face. Nobody was charged. The ledger is dark, and it always finds a way to balance. I'm your host. This is Dark Ledger. If this story opened your eyes, hit subscribe, because next week, we go even deeper.